right, we're gonna start our little fun thing here and let's get it back on the screen we want. Okay, beautiful. Thank you all for coming. I am Susie with Carefree Bookkeeping, hosting today's little class and lesson. And I'm so excited to have Natalie and Tony here with First Western Bank, and they're located in Eden Prairie, and they have several different locations. So I'm just going to hand it over to them, and we'll have room on the backside for Q&A questions. So go right ahead. Get started.
Hi, everyone. My name is Natalie Schultz. I'm a business banking officer with First Western Bank and Trust. And today I'm going to be covering a little bit about what banks are looking for on your P&L and balance sheet, what we do for a calculation of debt service coverage ratios. Also, we're going to cover a few things on collateral and give you some examples of things, why we are doing what we're doing. Okay, so first of all, there I am. There's Tony, who will be helping you guys with SBA understanding here in a bit. Today, I'm just going to cover the collateral, the debt service coverage ratios, and kind of the P&L and balance sheets information. The debt service coverage ratio is used to measure the business available cash flow to pay your current debt obligations. What does that mean, right? So today's loan is going to be repaid on your future income. That is what we are looking at. There's a lot of times where the bank is going to collect your past information to see how well your business is doing, right? The reason why we collect all this information is because we want to understand your business. Understanding your business helps us service you better, okay? So we are not trying to be offensive or invasive, but there are things that we like to understand to make your business grow. For instance, these profit and loss and balance sheets that you're going to find in your packet that Susie prepared today for us. She does a fantastic job here at Carefree Bookkeeping, and those financials are exactly what we're looking for. If you provide the bank with your own prepared financials, we may ask you to get a bookkeeper, because what we do is we go through and we look at them. We look through your income. We look through what you're paying, what your expenses are, what has affected you throughout the years of being in business. Where can you save money? And if they are not accurate, we cannot accurately measure how you're going to be repaying that debt that you're going to be taking out with us. Okay? So let's take a look at the balance sheet then. So in your page 3 and 4, okay, so I did a calculation on an example of a business cash flow. A business cash flow, some banks will add back in interest, your taxes, and your depreciation. Some banks will add back in a few other items. Today, I'm using the example of what I would look at on your profit and loss and balance sheet. So if you look at those examples on 3 and 4, we're going to take that net income, okay? That net income is not the income that I'm going to be using for your debt service coverage ratio. I'm going to add back in that interest that you paid. I'm going to add back in your Minnesota taxes that you paid. I'm going to add back in your depreciation. That is the total amount that I'm going to use for your debt service coverage ratio. And that is specific just for the business cash flow. So if I was only using business cash flow, I would take that number and I would divide that by your long-term liabilities, and I would get your debt service coverage ratio number. Today, the example that we are going to be using is a global debt service coverage ratio, because we are able to use that ratio as well. So if we go back to slide 4, after the P&L and balance sheet, we're going to talk a little bit about that global cash flow. Global cash flow is a combination of the ability to service the proposed debt using a global picture of your income, okay? So this could mean many different things. One good example of global cash flow is I received a P&L and balance sheet from a business customer. I went through there. I know their business pretty well. Something was different this year. I said, hey, who are you paying rent to? He said, well, we opened up another business and we're storing our equipment here, and that's okay. So because that's the business income and that business income is going to another entity, I want to pull that other entity in for global cash flow to make sure we're understanding the big picture of how much your business is actually making, right? So that is a good time for you to sit with your banker, have a conversation annually on what has changed. What are you doing differently? How are we able to help you get the funds you need and service those new equipment loans or that new line of credit that you need for your business? Okay, so using that, global cash flow could be different for investors, right? So if you have a big property that you're going to acquire and you have people that want to come in and invest in that property, we're going to take a global picture on that instead of just the new entity. Okay, that makes sense to the business and for the bank for collateral purposes. And we'll get into collateral in a little bit here. So here is the example of global cash flow that we've prepared for you today. The total available business income is annually on this sheet here. So if you take your annual business income and divide that by 12, that is your business's monthly income on the side there. Because we're using a global cash flow example, I'm going to grab your personal income. Maybe you run your business and your wife has a full-time job, or your business is something that you're doing in the nights and weekends and you are still a W-2 employee at somewhere else, right? So I'm going to take that income as well, divide that by 12. That's your monthly income from your W-2 employment. Then I'm going to take all of your long-term liabilities from your business. I'm going to divide that by 12. That's your monthly long-term liability for your business. I'm going to take your personal debts. I'm going to figure out what you're paying monthly on your personal debts. And then I'm going to add that and get your monthly personal debt at that point. So when you look at the numbers for the business and the personal, that top amount here, right, your total income for annual, you know, that's a pretty good number, right? That's why we want to take that global cash flow picture so we know exactly your ability to pay back the loan that you're taking out today. Okay, and then we're going to ask you a bunch of questions. Okay, what are you going to do in the future? Are you planning to keep your W-2 job? How long have you had your W-2 job? Because like I told you before, the loan that you're taking out today, you're going to repay with future cash. So we're going to ask you those questions. Okay, so on the next slide, you're going to see the actual formula that we have used to come up with your debt service coverage ratio. Your monthly income divided by your monthly total debt is going to give you that 2.51 debt service coverage ratio. That is a fantastic number. That is a great number to have because typically in Minnesota, the standard is 1.2. Some banks are different, okay? That's just the standard. So if you have a great bookkeeper, if you have a great accountant, if you're understanding what you're doing differently on your business, we can look at a big picture and find out how we can finance the items that is needed to make your business grow. That it's kind of like a puzzle, right? We're going to put all those pieces together to find out what the picture looks like when we're done. Okay, that's why we ask all those questions. That is why we look through those P&L and balance sheets annually for a business. A good banker will sit down with your customer annually with your information to find out what is your projections for this year. What are you planning to purchase this year? What does that look like for your income? Who do we need to put in place? What type of loan fits you best? And that's why we ask for all those things annually to make sure we're servicing you at the best we can. If we do not, we're doing a disservice to your company. No. So that is typical. So that is the standard formula to find the debt service coverage ratio. What is different is the standard. So what we're looking for is that 1.2 times, right? So because you're at 2.51, you qualify because you're not below that 1.2. So anything below that, we kind of take a look and say, okay, last year you had this. What has changed this year? Why is your debt service coverage ratio lower? Your revenues are going up, but your net income is going down. What do we need to look at? Sometimes companies are growing too fast that they're renting equipment, or they had to hire employees, or they had to get an office space. You know, what are we looking at? What changed every year? And that is those numbers that we look at. Next one is we're going to talk about collateral, okay? Collateral is a little bit different. Collateral, the banks love security, right? The collateral is our security that if you're not going to pay us, we're going to come get that collateral and we're going to get our money either way. So the big thing about collateral is sometimes people don't understand business-wise is, for instance, a revolving line of credit. A revolving line of credit sometimes is unsecure. Sometimes it's secured by your business assets. What that means is we are able to finance lines of credit for a business as long as we're taking their accounts receivable and filing a UCC filing on their business to do a blanket coverage on their assets. So if that business goes under, we have that UCC filing saying, we're going to take all of this equipment, sell it off in an auction, we're going to get our money back. The UCC filing is a great tool for all the banks to figure out who has loans where. So typically we will do a UCC search, and we're going to find out if that business has another loan at another bank with a blanket filing. So we're going to know, right? If you come in and they apply for a line of credit. So we're going to know that information. So the UCC filing for accounts receivable, most of the time for accounts receivable loan, they're going to ask you for a borrowing base. What does that mean? That means the bank wants you to send your accounts receivable. Sometimes it's monthly, sometimes it's quarterly, to see where you guys are at, where your business is going. Because if we have an accounts receivable loan and we haven't talked to you in a year and a half, and all of a sudden you're like, oh, well, I stopped doing that a while ago. And we have the loan, right? So for security reasons, for us to get our money back, we want to make sure that we're talking to you, knowing what that, how much business you're doing, what are you doing moving forward, what's working for your business, what's not. Okay. Equipment loans. A lot of equipment loans, we want to make sure that if you're purchasing a vehicle, we want to make sure that your vehicle loan is based off the depreciation of your value of your vehicle. A good example of this equipment is when in 2021, all the used vehicles were really, really high, right? So great time to buy a vehicle. No, my son actually is in this predicament. Bought a vehicle, 2021, $20,000. He said, I'm going to go trade this in. He went in the other day. They're going to offer him $9,000 for it. He was like, Mom, what happened? I said, the depreciation of the vehicle, right? So we want to make sure that vehicle, if you're on an 84-month loan, that means we have looked up and we know the amount of time that we need to pay that loan off before the value of your truck goes down significantly. Okay, so that is why we come up with the 60-month term or the 84-month term, because what the bank doesn't want is for you to purchase a vehicle and 3 years later, you're still at 100% loan to value and your business goes under, right? So those are the terms for a collateral that we look at. And that's where you're coming up with our 20% down as well. So most of the time, equipment loans are either 75% loan to value or 80% loan to value, depending on what type of equipment you're purchasing. Okay, so we look at all of those things with collateral. There's a big different way of doing things for what product works well for your business. I have a lot of pictures on there that Susie put in there that are typical for business loans, right? Sometimes people do a home equity line of credit on their house to start up their business. There's a lot of different ways to do things. There's a way to do equipment for tools and the smaller things that you need to do. And Tony will talk to you guys about that here shortly. Well, I'd like to introduce Tony today. Tony is going to be talking to us about SBA.
Thank you. Yeah, that was good. A lot of those things there, we'll talk through some of these SBA programs and give a little brief overview on each of these. These are the three most common. So anyway, a little bit, I am Tony Sipe, Vice President of Commercial Banking at First Western Bank and Trust. And I've been doing SBA lending for a little over 20 years. So I've seen quite a bit of things change in the SBA world, but they're great programs, and I tell people all the time, don't be afraid of an SBA loan. Sometimes they, SBA, oh no, there's all this paperwork and that, but they are good, and that's why you need solid bookkeepers behind you, because that is a huge piece of this. So I'll just kind of go over briefly here the SBA Express. Now these are maximum dollar amounts that you see here for these types of loans. So the Express is a $500,000 max. They're great for little micro companies, startups, things like that. And we'll kind of touch on that as we get to the next slides. The 7A loans, typically for a little bit larger projects, $5 million cap on those. And again, we'll touch more on that. The 504 has a little bit different limit there. You'll see that up to $5.5 million. What that is for manufacturers. So, the SBA several years back said, well, let's enhance some of that growth. Manufacturers gave them a little bit more room. So, and that's a per project. So, your total outstanding for that can be like 16 million on that. So that's a per project number on the 504. Yeah, just on the 504. Yeah. Yeah. The 7A, that's a good question. The 7A, that's capped at the 5 million total. So, you could have several loans with SBA guarantees in there, but can't exceed that 5 million. There are some other types. There are like exporting loans, there's international trade loans, things like that. Really rare, you don't see it very often. So I'm not going to dive too much into that here, because you just don't run into that often, but they are available and they're great programs as well. Who qualifies? It's you have to be a for-profit company. No nonprofits, they don't. PPP was a different animal, so they kind of allowed that, during that stretch, but that's not a typical thing there. So I always say nonprofit, non-eligible. It's just simple that way. So SBA size standard, it's different for every industry. So the SBA has a great guide on their website. I would encourage, Google or Bing that, and you'll see, you can type in kind of what your company is, what type of business it is, and it'll spit out the size standard that is eligible. So, what they're doing here, these programs are for small business. So they don't want Amazon coming to them or some large corporation saying, hey, I'd love to have an SBA guaranteed loan. Not that. So that's the reason for that. Good character, credit management, and ability to repay. Ability to repay, certainly we just touched on a little bit. Natalie did a great job with that. You had asked earlier about the projections. This is where that comes in. Yes. So they actually require 2 years of projections, the SBA does. So can you use that for your your debt service coverage? Yes, you can. Keeper's great for the, yep, that's perfect. Yep, that's exactly right. To help you kind of guide through that. You know, we're gonna look at it as the bank, and you know, what we want to see is, are these reasonable? Right? I mean, does this make sense for that type of business in that industry? So we're gonna look at that both on the income and the expense side. What makes sense for that kind of business in that location? You know, we don't know everything. We're gonna, you know, we trust that you're putting together good numbers and that, but we're gonna look at it too and just say, hey, okay, and we're gonna go down those line items and talk through that. But that was a great question, because that comes up really often in SBA lending, because there's so many startups in it on the SBA side. Okay, they don't have the history. You know, they have maybe like businesses that they've run, or we can look at some of that from an experience standpoint, but they don't. It's a new business. They don't have 2 years or 3 years of financials. So yeah, that was a good question on that. Eligible business types. You know, again, it's kind of that for-profit. The thing, what the SBA wants is that the businesses or the products and services are available to everyone. That is kind of what their big sticking point is on that. It's business type. So that's kind of, you just can't really exclude certain groups and things like that. That would make it not an eligible program.
Nothing like mark, not like specifically for seniors.
Right. Yeah, I mean, there are some of those that they'll allow 504 side, things like that. The example that the SBA uses all the time is curbs for women. Okay. So they'll say, well, it's only women can use it. That's the one they always throw out as their example, because it's just an easy example showing where certain people can use the product or service, and that's where it really comes from. Okay. So we'll start here. You know, the 7A is the most common. It's an excellent program. I mean, this has been around for decades. It's a solid program that really covers most of what you're going to need, what you're going to run into. So, you know, on the term loan there, that's just installment loans. You know, that's pretty, not lines of credit. Okay, so that's a term installment loan. The next three there, the expansion, renovation, new construction, and purchase land or building. You can use 7A loans for those. However, they typically fall under the 504 projects. And we'll get to that as we go. And the reason for that is more of the long-term fixed rate money that the government can kind of back there. So that's why, but you can use a 7A for it. I don't see it that often, honestly, for that, but it's there. It falls under that bucket. What you'll typically see the 7A used for are those next three: purchasing equipment, leasehold improvements, and working capital. I would even go down to the bottom three too: the inventory, startups, buying of the existing business. Those six are really where the 7A comes in.
Anybody can do that.
Yeah, so that is the compelling reasons is yeah, you know, people ask it once in a while. Here's what it really is. Here, I'll give you a couple examples. Yeah, there's two examples I like to use. Number one, you have an existing SBA loan or existing debt at your bank and you don't get along with your bank. It happens, right? It happens. So they'll allow you to take funds and get it on an SBA loan out to another bank. Okay, so that would be maybe a spot you have debt over there. Yeah, transferring the debt to a new lender. That happens. It's rare, but it happens. The other one could be, maybe you can explain a reason that there were some debts piled up. Maybe it was a medical thing, or maybe, something family related, something like that. Occasionally we'll send something into the SBA. Okay, we can explain why this is something that needs to be refinanced. Again, subjective, it's a tough one to crack, is that one. But those other ones listed there are, so, that's what you're basically going to run into, are those particular things. I just closed one yesterday that was a combination of all of those things. They're buying inventory, they're starting the business, they had some existing locations, but they needed money for leasehold improvements, equipment, all of it. And so it can all kind of fall into that bucket, and that's what's really nice. Yeah. Yeah, so like in that example, or in the example from yesterday would be, we're starting up a restaurant, say, and we need equipment, we need inventory, we need to build out this space that we're leasing. So we can utilize this program and get, a little bit of a government-backed guarantee there, because it's a riskier business. It's a startup. So that's what these are for, is to make the bank comfortable, but also allow the borrower to be able to access capital. Because, if you went to the bank for a traditional conventional loan on that, it's going to be harder to get, because, the lack of collateral or things like that are in those. So that's where this program is such a key for new and young businesses, but also just expanding, right? I mean, adding locations, things like that, that's a big deal. So I just want to touch a little bit on the benefits to the borrower on that. With this program, we'll kind of run through these quick here. The long-term financing, so that's nice. You can get 10 years is what you usually see on a 7A. And that's a fully amortized loan. So there's, as you see down here, there's no balloon payments. So they're not going to, amortize it out long and then have you have a balloon there. Improving cash flow, you'll see that a little bit with existing businesses, where maybe, like Natalie had a good example, where maybe what happened in 1 year, the debt service coverage got tight. Why? We're going to talk about that. Maybe there's a loan product here that we could stretch it out if it makes sense, right? To stretch out the payments and improve the business cash flow. Because you might need, you're expanding all the time, you're growing, things change.
Usually in SBA, the first thing we suggest when there's a cash flow problem.
Yeah.
So.
Yeah.
Because the SBA loan is, you don't have to repay it right away either. You have, how long is the term?
Well, like on these, this particular product, yeah, you're going to have a fixed term, right? You're going to have a 10-year term, and it'll start typically right away.
Oh, the 7 years. Because usually the ones our clients have, they have like a. Is that what
Oh,
that is?
yeah, the COVID idle.
Okay.
Yeah, that was a good program for people that needed that, though, that relief.
Okay, that's what that is then, because the EIDL.
Yeah.
Yes.
Okay.
Yeah. That idle loan was nice. You didn't have to, repay for a couple of years.
Yeah, because I have one.
Get yourself stabilized, and then, then
Okay.
it's on to that. Yeah, so I think touching no prepayment penalties, that's nice. That's a good thing. And then here's the guaranteed percentages that will typically apply for through this program. The SBA Express program is an extension of the 7A program. So you'll see over there in the eligibility for proceeds, a lot of that is the same as the 7A. However, the one major difference is that one on the bottom, and it's a revolving line of credit. We write these all the time. I'll just say, because these are excellent loans for existing businesses. Okay. Working capital, seasonal businesses, things like that need lines of credit. This is a great program for them. The other nice thing about the Express, the word express, of course, means faster. I think it's supposed to be that we can approve them faster. And the reason for that is the bank has the delegated authority to approve that loan. Okay. So the SBA has given the bank that authority that, hey, you can make that loan, plug it in, plug and play kind of thing, plug it into our system and it's good to go. That doesn't mean that you can do outside of those other eligibilities, right? Yeah, all of the documentation requirements are the same. So the bank still collects all of those things. It's just not submitted. It's submitted differently, which is intended to speed up the process. So again, very nice for small loans. That's why that 500,000 cap, that's why they've allowed that. But with that, the bank will get a smaller guarantee percentage. Okay, so there's a little bit more risk. The SBA didn't jump in and do a full approval like they will do on a 7A. So that's why you'll see that guarantee at 50% versus 75% or 85%. So these are, you can have these out for up to 7 years. So that's really nice. And typically the bank will have the revolving line renew every year, because we want to get updated financials and talk to you about your business and see where you're at least annually. I recommend you talk to your banker much more often, because you're planning all the time. The businesses evolve, grow, they expand. Everything's changing all the time. And if the bank as your partner knows about that and is ahead of it, makes it so much easier when you come in and apply for, hey, Tony, I need this, or whatever it may be. We're already ahead of the game. I did want to touch one other thing on revolving lines. And I think, what you don't want to do with a revolving line is buy fixed assets on it. You don't typically want to buy vehicles, buy big pieces of equipment with it. And the reason for that is that you're not going to repay that large amount with that asset right away. That's an asset that's a tool for you to make money, but it's not like inventory. Where inventory, you're getting it in, you're going to sell that inventory and pay the loan back. Okay, does that make sense? Because if you buy a vehicle on there, that typically should be on a term, where it's amortizing down because that asset is depreciated. And you want to kind of match those up. Natalie talked about that a little bit earlier, is we want to kind of match up how that's depreciating down, so that you're not getting kind of backwards or upside down on assets. We kind of finish up here with the 504. I'll go over this really briefly. So these are loans for typically larger projects. This is buying commercial real estate construction of commercial real estate. In other large projects, you can use it for, like a manufacturer may have very large equipment that they need, so you can use these for that. If you're gonna buy commercial real estate, as you see there, you have to have at least 51% of it. You are occupying it, your business is occupying it. So you can have some lease space there. A good example is what you see in the background, a strip mall. If you're occupying 51% of that, you could have somebody on that other wing leasing. Construction, though, is a little different. They require you to have 60%, and then that actually graduates up to 100. So the idea is you're building that building for your business, not as rental real estate. And then big, like I was saying, big equipment projects. The benefits, the nice low down payment, I mean, that's like very attractive for commercial real estate, 10, 15, 20%. Kind of depends on the type of business, the length of business that's been in operation. Equity may be borrowed. This happens a lot on these. And what you'll see on that, many times it will be someone used a home equity loan that they already had to borrow this down payment. And they allow that, okay? So they allow you to leverage another asset to be able to do this. So that's nice if you don't have cash, but you might have equity tied up in in other real estate or something like that. When you do these, you not only have the bank in there, there's a certified development company that actually has to facilitate this. So the bank is the lender on the first mortgage, which is going to be 50% of the price or project. Then the SBA comes in on this second loan and has the, say, 35, 40%, and then your 10% equity. It's just the structure of a typical project. Fees can be financed. You can put that in the total project. And that nice part about that CDC portion, or that SBA portion, we call it, is that it's going to be a long-term fixed rate. So that part of the loan will be 20 years, 25 years fixed at typically a lower rate than the bank's giving you on the first. So that's a very attractive thing. That's why these are a very popular product. Again, no balloon payment. There is a balloon payment typically on the first mortgage, the 50% mortgage that the bank holds. That one you'll typically see like a 5-year balloon. It might have a 25-year amortization schedule, but you'll have a 5-year balloon. Or a 10, just kind of, you'll see 5, 7, and 10 years are the typical. So the reason that balloons are in place is for banks to somewhat have control over the rate, right? Because if I'm going to give out fixed money for 25 years at, well, what rates we're at in those 4%, look at what would happen to me now. Right? So I've got all that money out at 4%. And now the standard rate is, say, 7. And my cost of funds have gone up. I'm now back. That's why you'll see these. Yeah. So again, that's why you see balloon payments on the bank side, is because then they can reprice it to that day's market. So I think that kind of concludes what the SBA portion of it. Did you guys have any additional questions?